Today, we're sharing the 3 KPIs you should be tracking in your accounts receivables team. As a business owner or finance leader, it's crucial to track and optimize your receivables process as it directly impacts your cash flow, profitability, and customer relationships. In this video, we'll share the main metrics you should be tracking, how to measure them, and how to improve them. Firstly, you should be tracking your days sales outstanding. This may seem like an obvious one, but you'd be shocked at how many teams aren't keeping track of this metric. It's important to track your days sales outstanding month over month so you can see how your team's performance and your debtor book is progressing over time. Your days sales outstanding measures how many days on average your customers take to pay their bills. You can calculate it by dividing your total accounts receivables balance for a given period by your total sales, and then multiplying that amount by the number of days in the period being measured. By tracking your DSO, you can identify any potential issues with your accounts receivables process and take corrective action before they become bigger problems. If your DSO are high or climbing month over month, try implementing some accounts receivables management best practices or an AR management software like Chaser to help reduce them. Another important KPI to measure is cost to get a single invoice paid, or your operational cost per collection. You can measure this by adding up your total monthly labor costs, so time spent on follow-ups, multiplied by your hourly labor cost, and adding that to your monthly outright costs, which could be your email provider, tracking an invoice software subscription, phone fees for following up on late payments, and costs like that. Then divide this total by the number of invoices paid per month. This KPI considers your team's execution and capacity rather than just your receivables results alone. This can optimize your team's efficiency by helping you decide when to escalate certain late payments to external debt recovery if your cost per collection is too high, where automation can be used to help your team maximize their efficiency, and how you can make better use of resources in your accounts receivables team. In our view, a largely underused accounts receivables KPI is number of revised invoices. There is no fancy calculation for this, it is simply how many invoices your team need to revise in a given period. If you're regularly revising a high number of invoices, this can be an indicator that you're experiencing human errors, for example, missing relevant information, or sending the wrong invoices to the wrong customers. A high number of revised invoices means confusion, poor customer experience, delayed payments, and inefficiency. This is an indication that you need to improve your invoicing process and ensure you're invoicing correctly. In order to make improvements, firstly, start by keeping track of the disputes and queries raised and update your accounts receivables process to address these issues. Attaching invoice copies to any invoice-related communications can also help reduce the amount of queries or disputes raised by customers. Utilizing a payment gateway or portal where your customers can easily go in and access all their payment and invoice details in one place can be extremely valuable for this. Making sure that your invoice reminders are reaching the right contact within your customer's organization is also essential. We recommend confirming payment contacts with an email address and phone number to reach them as part of your standard onboarding process for all customers. Depending on the number of invoices you issue, a high rate of revised invoices can also be an indication that you should move from billing manually to an automated system with invoice creation. We hope you found this video helpful in understanding the key KPIs for accounts receivables and how to improve them. By tracking these metrics and implementing these best practices, you can streamline your receivables process, reduce payment delays, and enhance customer satisfaction. Thank you again for watching, and we look forward to helping you get paid sooner.